the theme for today is the crystallization of an idea that has been forming for a while, I think, in all of our brains, and I think probably at different times. I think maybe, Mike, you may have sort of gotten an intuition on this a little bit earlier than some of us, but the recognition that as investment concepts are published, which amount to basically new technologies in the domain of investments, they have a similar adoption curve where there's the real innovators that identify the anomaly in the first place, and then there's a class of early adopters that tend to be a little bit more adventurous and risk taking, at least like in the context of the risk of complexity and novelty. And then, things are published, it gains traction with an academic group, it gets published in a peer-reviewed journal, and all of a sudden it enters the Overton window and it gets broad adoption. And I think this is general belief in the factor or smart beta world that the fact that people know and recognize and adopt strategies to harvest excess return from a new investment concept doesn't fundamentally change the nature of that new idea. And I think we all sort of operate on that basis. We examine the empirical work, the publications, maybe we run some of our own back tests to validate the original published research and say, okay, this particular set of characteristics has traditionally led to or produced excess returns. And then we expect that historical profile to carry on in the future. And what investment technologies have is a reflexive nature that most other technologies or concepts don't have, that fundamentally changes the nature of or the state of the market after something is published, right? And so this recognition that publication itself changes the nature of market participants and therefore should reset how we think about expectations for that concept going forward.
Yeah, so I just actually have it up on the screen here, the idea of this trajectory of new investment concepts. So basically, the idea is that there may be an anomaly in the beginning that nobody's really talking about. You have this pre-publication premium, and you hover around this space here for a while. Then an academic decides to publish their findings. It gets widely adopted. You get a bunch of money into it, so you get a late majority. You get so much money into it, it may lead to an abandonment phase, at which point everybody leaves, but enough players stay because it's painful to still be in it. There's probably going to be an equilibrium premium invested there, but there will be an abandonment phase. It'll be when enough AUM leaves it, people ignore it, and but not enough so that it goes back up to the pre-publication premium. Right?
Exactly right. So there's the top line there is, I guess, the threshold T-stat that is required for a reputable journal to publish research, right? So you've got many people doing research on risk premia or anomalies, and in order for that research typically to be published, that anomaly needs to exceed a certain level of statistical and economic significance. And so it's got very high economic and statistical significance, representing the height of that horizontal line above zero, right? And the idea is that it was very high before the anomaly was brought public and gained recognition from credible academics and was published in credible journals, and before everybody bought into the economic intuition behind the premium. But by virtue of so many people buying into the premium, that premium eventually goes away or even inverts. And I think it's worthwhile going back to why some of these premia exist, right? And certainly back in the days of Fama French, and largely still today, a wide variety of investors and academics still prefer the explanation that most of these premia that exist because of they represent a certain type of risk. And because they represent risk, they can't be arbitraged away because it's just, an investor is taking more risk and therefore getting more return, right? But I think what a lot of the literature has shown, and there's been some really great papers published over the last 5 years or so that goes back and evaluates the returns to premia out of sample and post-publication, and have sort of validated this understanding of why premium exists. Typically, I think I can certainly adopt the view based on the literature that most of these premia exist because of behavioral preferences. So you've got a cohort of investors that for some reason or another doesn't want to own securities with certain characteristics. I mean, an easy example of this is sort of sin stocks, right? So you've got a class of investors that don't want to own sin stocks. Therefore, sin stocks are priced at a discount, and investors that are willing to own sin stocks will go in and earn an excess return from owning securities that another class of investors doesn't want to own. But what isn't often recognized is that by virtue of a large number of investors crowding into securities with those characteristics, I mean, imagine there was originally $1 billion worth of capital that was avoiding securities with these characteristics. As soon as $1 billion of capital comes into securities with those characteristics to arbitrage that discount or anomaly, now you've got an equal amount of dollars that don't want to own those securities and an equal amount of dollars that want to overemphasize those securities. So we would expect that anomaly to go away, right? That those two pools of capital have neutralized one another. But what happens when more money flows into securities with those characteristics than there was originally investors that wanted to avoid firms with those characteristics? Well, at that point, we'd expect that premium to actually invert. So what was previously securities with certain characteristics were expected to deliver a premium, an excess return. Now those securities would be expected to deliver a discount. In other words, to deliver negative excess returns for whatever period exists until enough people abandon that strategy, move away from it, and that market or that discount can be in a new equilibrium where you've got the most disciplined investors who can tolerate a certain lower level of premium that are just going to stick with it no matter what. They're the diehards, and they will earn some lower premium but substantially lower probably than the original pre-publication premium. And the literature that I've seen that have been published over the last 4 or 5 years suggests that discount is somewhere in the neighborhood of 50 to 60% relative to the premium that was originally published.
And I suppose, like, if we assume that those multiple premiums are a real thing, then the benefit of holding on to it, even though it has a lower risk premium than pre-publication, is that supposedly they're non-correlated to each other. So there's value there. And I think what we've posited is we would assume that the go forward post-equilibrium premium will be more similar to the
equity risk premium,
or
the credit risk premium.
Yeah.
Right, because in the back test, a lot of these end up being very, very high sharps, right? And we're looking at now 0.3s to 0.4s, if that.
Yeah, I think this idea of reflexivity, right, which is what we're talking about. I think this has been around for some time, and it counters the efficient market hypothesis, I think, quite eloquently. And people have different levels of intuition as to which one of those is actually true.